Welcome to this explainer. Okay, so if you've been looking at the macroeconomic data recently, you are probably feeling a bit of financial whiplash. Seriously, it's like we're living in a massive economic paradox right now. On one hand, we've got this robust GDP expansion, often blowing right past expectations. But then, boom, it collides head-on with a stubbornly sticky core consumer price index. Traditional economic models would tell us that all this aggressive monetary tightening should have totally cooled the engine by now. But nope. Consumer spending hasn't collapsed, and inflation is just refusing to quietly drop back down to that coveted 2% target. Today, we're going to completely demystify this contradiction. We're breaking down the exact mechanisms driving this divergence and exploring why conventional wisdom is being seriously stress-tested by a resilient labor market and persistent price pressures. Let's dig into the numbers and see what's actually happening beneath those headline figures.
Section 1. The Economic Tug-of-War.
Okay, let's dive into this. The economy is currently sending us two wildly conflicting signals, creating a completely unprecedented macro environment. First, think about the labor market. Job growth remains just remarkably robust, literally defying almost every expectation of a widespread slowdown. We're consistently seeing payroll additions outpace population growth. This keeps unemployment at historic lows, and crucially, it puts serious negotiating power right to the hands of workers. Wage growth has actually accelerated as companies fight to retain talent. But, and here is the heavy reality check, tethered right to that upward trajectory is the massive anvil of inflation. The skyrocketing cost of living is effectively neutralizing those wage gains. It creates this incredibly frustrating friction where earning higher nominal dollars just doesn't translate into an increase in real purchasing power. It's a classic textbook paradox playing out right in front of us. The sheer momentum of the labor market is generating the exact consumer demand that keeps prices elevated, forming a feedback loop that policymakers are really struggling to break.
Section 2. Where the pressure lies. Beyond all the aggregate data, this paradox creates a fascinating ripple effect, and it travels all the way from the kitchen table straight to Wall Street. It really begins with the immediate, everyday pressure on households across America. Because those nominal wages are fighting a losing battle against inflation, discretionary income is just getting squeezed tight. A huge driver of this? Rising energy costs. Think about it. When a household has to allocate a significantly larger chunk of its monthly budget just to fuel vehicles, heat homes, and buy groceries, well, they inevitably pull back on non-essential spending. And this is exactly where the macro data hits the micro level. That pullback at the cash register signals reduced forward earnings for consumer discretionary sectors. So when corporate profit margins start looking vulnerable, that everyday household pain instantly morphs into institutional anxiety. Equity analysts downgrade earnings forecast, bond yields fluctuate wildly on those inflation fears, and investors are kept totally on edge, constantly rebalancing their portfolios to hedge against the volatility. It's wild how the everyday consumer's depleted savings literally dictates the risk appetite of institutional investors.
Section 3. All eyes on the Fed. So, the crucial point is, with inflation stubbornly persisting, despite a historically aggressive tightening cycle, the entire financial ecosystem is basically holding its breath, waiting on the Federal Reserve's next moves. The central bank is trying to orchestrate this highly elusive soft landing, basically trying to cool the economy just enough to defeat inflation without triggering a massive recession and wrecking the labor market. But the sheer persistence of that strong job growth we talked about, it severely complicates their job. If the Fed pivots to rate cuts too soon, they risk reigniting the inflation fire, letting that pricing genie permanently out of the bottle. Conversely, if they hold rates higher for longer, the compounding pressure of expensive credit could suddenly snap the back of small businesses and heavily leveraged corporate borrowers. That would turn a resilient economy into a severe downturn really fast. This profound uncertainty over future interest rates is literally paralyzing capital deployment right now. Experts are parsing every single word from Fed governors, just looking for a clue.
Section 4. What happens next?
Ultimately, this dilemma remains completely unresolved. We are literally standing at a critical juncture in economic history. Will restrictive monetary policies successfully drain the excess liquidity and cool inflation without triggering widespread layoffs? Or are we entering a totally new structural era where stubbornly high prices, driven by persistent labor shortages and geopolitical supply chain shifts, simply become the new normal for global corporations and everyday consumers alike? The scales could realistically tip either way in the coming months, and the data simply refuses to paint a definitive picture. Thank you so much for joining me for this explainer. Keep a very close eye on those upcoming CPI prints and rate decisions because they are absolutely going to dictate the trajectory of this entire economic cycle. So, with all these opposing forces at play, what does this ultimately mean for the future of your own wallet?